Today, we are going to look at a case study where an individual is interested in a very large whole life insurance policy. He's interested in funding the policy with $300,000 per year. So that's a lot of money going into a policy. Now, why would he be interested in it? Well, he does have some experience with whole life insurance, meaning he understands how it works. He has a policy in place already, but here's the specific reasons. So he's 40 years old. He's an attorney. He's interested in a policy for the following reasons. 1, it's a safe place he can position some of his money. 2, he's interested in using it specifically for real estate syndication deals. And then 3, he is in the highest tax bracket. So the tax benefits that come with the cash value are very appealing to him. This is a big reason why he likes storing cash here. It's safe. He knows it continues to appreciate, being that the cash value does grow tax-free, provided we don't cash it out or trigger a MEC, anything that would trigger a taxable event. I can use that cash value tax-free. And then also I've got the liquidity feature of being able to take loans for real estate deals, which are generating a high return for him. That's his thing. He's done very well there. So that's why he's interested in a policy. But then some of the specific details here. Here's what he wants to do. I want to fund the policy with $300,000 per year for 7 years. I might want to go longer than that, but it's not a priority. So he specifically mentioned this. However, we have gone back and forth at looking at a policy where maybe he goes for longer than 7 years. We're going to hit on that briefly when we look at the numbers. Now, what he's interested in is the most cash value. And the simple reason why is if I've got more money, then that's the whole purpose of putting money in the policy, to maximize my money. But then I've got more money I can use for opportunities. So when it came to the company selection, what company is best for my situation? So if he's asking this, he wants to put this amount away, he's interested in these benefits, whole life insurance with any company can provide these benefits. Here's where I would start though. Number 1, I would always look at quality companies. I prefer the 4 major mutual companies. That's my preference based on the historical track record we've seen with real policies that have lived the test of time. Those 4 are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Nothing against smaller companies. We've just seen a lot of proof of performance with the major mutuals, which is why I like them. And then number 2, setting it up to be very, very flexible. What I mean when I say that is if this is you and you said, I want to fund $300,000 per year. If you were 100% confident that you could write a check for $300,000 year in and year out, would you need flexibility, specifically when it comes to funding the policy? No, because you're 100% confident that you can write a check for $300,000 every year. However, what if you were confident that you could fund the $300K per year, but your cash flow fluctuates over the course of the year? So you might have a policy date of June 1st, but you're not guaranteed that June 1st of every year, you'll have $300,000. That's where flexibility can really come into play, because depending on the company you select and the rules that company has with their policies, you could have a policy where I can fund up to $300,000 per year, but I only commit to $30,000, a minimal amount. Now I'm billed for a minimum amount. I have no problem hitting that. And then 100% at my discretion, I can just add more money to the policy. Different companies have different rules. We'll talk about that a little bit as we look at 2 of the 4 major mutual companies. So we'll look at scenarios with Mass Mutual and Guardian. Option A, Mass Mutual. That is what he was originally interested in and has the most interest just in our conversations thus far. So if he's going to fund $300K per year for 7 years, and he wants to get the most money possible out of his $300K per year payment, I would go with the 10 pay. And that can be set up with a minimum premium of $30,000. With that said, he's requested the 15 pay, I believe, more than once, just in our planning and our back and forth. So the reason why, going back to what he originally said, $300K per year for 7 years, maybe longer, but not really a priority. So this was one of the first things he had mentioned. However, in asking about the policy and seeing how they work, he said, you know what? What's it look like if I can add funds for a little bit longer? I might want to do that. I'm not sure, but it's not a bad option to have. Really what I'd like to see, or what's beneficial to see, is these two options side by side. The 10 pay will produce a greater internal rate of return, but how much more in value are you getting? Meaning if you pay the exact same dollar amount into a 10 pay policy and a 15 pay policy that are designed equally, how much more money will you have with the 10 pay? And if it's significant, I'll go with the 10 pay. If it's a number that I look at and say, that's not that much, I view that as really the cost of going with the 15 pay because I'm purchasing the ability to keep adding money for a longer period of time. Because if I can get more money into it, well, then I'll have more money. Yes, I'll have a slightly lower growth rate, but on a larger bucket of money. Let's take a look at this actually. So we'll look at the two side by side. We've got our 10 pay and 15 pay with what he will likely do. So what do we got here? 10 pay on the left, $30,000 minimum premium. The true minimum is a bit higher with our term riders and such, but it's close to that. $300K per year. First year cash value, $270,000. That's a cash-rich policy right out of the gates. There's your first year hit, about 10%. Break-even point, year 4. We're at $300K per year for 4 years. I've paid in $1.2 million. My cash value is more than $1.2 million. And this is the annual internal rate of return that just isolates the yearly growth rate. There we go. And then we've got the 15 pay policy. Slightly weaker upfront, break even just about year 4, positive year 5. There's my IRR. We can take out the IRR and just look at the cash value difference, because this is really what I want to look at here. What's the difference? This is displaying how much more or less you have in the 15 pay compared to the 10 pay. By the 7th year, $22,000. By the 15th year, $82,000. It's over 80 grand, but he's paid in 2.1 million. Is it a huge amount relative to the dollar amount, $2.1 million, and also over 15 years? It's not huge if you were to associate a percentage with that. But here's the thing. If he said 7 years, that's going to be my max. Or even if I do go longer after talking it through with my wife, looking at the different options and such, maybe I go for 10 years. Then I would still go with the 10 pay. If he said 7 years, definitely 300, but hey, what if I want to keep doing 100K per year? And I could definitely see myself doing that through year 15. Then what would you do? Probably the 15 pay, because I can continue to add to an existing policy and not have to start all over with a new policy after I surpass the 10-year funding point. So what we do in a case like that is put them side by side. Here's what I would look at. What we have to the left is the 10 pay policy. First, we've got funding it for 7 years, which is what we just looked at. This produced the highest cash value and death benefit long-term with the 7-year funding period. And then we've got the same policy. You'll notice the values are identical through year 7, but funding it through year 10. So what does it look like if I get a total of $3 million in, meaning I keep on adding to it? Compared to this 15 pay policy, the plan of 7 years, compared to funding it for 15 years. So that's an overview of option A. Remember what option A was? Mass Mutual. Which one would you pick? And then we've got option B, which is Guardian. And here we looked at their L95 and also their 10 pay. Let's take a look at the same comparison. With their L95, we have 2 versions up there, and the main reason why is because if he likes more cash value up front, that 5% PUA fee accomplishes that. Also, what's not here, we covered this in a different video based on the same case study, is that 5% has stronger guaranteed values. I believe we covered the guaranteed values on an earlier video. I'll double check that. But if he's very, very attracted to stronger guarantees, this option is very attractive when looking at that. But I've got the L95 with more upfront, 10% gives more long-term potential. You'll notice with the L95, I've got that minimum at $30,000. That $30,000 includes the base premium and term rider. It might be just a tad bit higher, but it's right around 30. And then you've got their 10-pay product, which is similar to MassMutual's, but it does have a higher minimum requirement, at least based on what we can illustrate, where the minimum, we can typically set that base premium is whatever the total payment is divided by 6. That's where we came up with the 50. So this does have a higher minimum requirement. So if he likes the idea of having a 30K minimum and going up to 300K at his leisure, this is something we would want to disclose so he's aware of it. Is it high based on his income? Probably not, but again, it's always our personal preference and such. So this is a nice comparison of the Guardian options side by side. And really what we'll do is just go through the pros and cons, see which one you prefer personally. In a case like this, you've got two quality companies. You cannot go wrong with either of them. If we're talking about the flexibility piece, with MassMutual, if I'm going to fund a total of $300,000 per year, I should say it this way, I have to pay the premium and everything above the premium at the same time with most designs. So regardless of the product, if I say I'm going to pay $300K this year, I can start off at $300K. What if next year things were slow? So when your premium due date comes on June 1st, you can only pay in $100. What we would do is adjust your payment to $100 in the second year, okay? What if you wanted to add more later during that year? Could you very easily? No, you might have to go through underwriting, depends on how the policy was set up and such. It's difficult in many cases to add funds at discretion to a MassMutual policy. What we would have to do in order to add funds very conveniently is wait until the third year when the minimum's due of 30, and then we could scale it back up to 300 or any dollar amount you'd like. Doesn't have to be as high as 300 if you didn't want to do that. Where Guardian's a bit different, take the L95, you could commit to about 30 per year. That 10 pay was a bit higher, it's about 50. And then 100% at your discretion, you could just add the rest. So they are more flexible there, Guardian that is, which some people do like. If the flexibility is not needed, MassMutual does have a higher dividend right now. That 10-pay and 15-pay product is very, very attractive. There's pros and cons to both, especially when you start to look at the loan features too. People we work with do go with both carriers. Depends on the individual situation. What we always try to do is provide a thorough overview on both carriers and different products. This way, when the product is selected, the individual is comfortable, they know what they've got, and they can use the policy to the fullest degree as the years pass and use it for what they'd like. So I hope you enjoyed this. Please let us know if you did. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.